You are listening to Digging In Podcast, presented by Rooted Wealth Advisors.
All right, Andrew Lee, welcome back. You are a viewer favorite on the Digging In podcast. Everyone loves the markets and mustache or mustache and markets. I can't remember which way it goes. But welcome back, man. How you doing?
I'm doing pretty good. It's always a pleasure to sit down and chat with you about the market. So I'm looking forward to it.
Good. Yeah, I mean, you actually were just telling me before we started this how pumped you are to do it. So, well, without wasting any time, really just kind of want to hop in. Last time we chatted, I think it's been, 5, 6 weeks ago. The market was, really recovering quite nicely, for a lack of better terms, from their April lows this year. And, we had a lot of things coming up, right, when it comes to, Fed meetings, economic data. I think my question just becomes overall, how has that played out over the last, 5, 6 weeks compared to when we talked?
Yeah. So, I think first and foremost, we got a little bit of clarity around tariffs. And I say a little bit because part of it's just pushing or kicking the can down the road, right? So that's kind of where the clarity comes from. With that also, I think the market expected the Fed to hold rates where they were. We saw that happen. Employment data has, remained relatively the same. Inflation data, we can get into that a little more later, but has remained, relatively the same. So I think the market was already pricing all that in. Everybody got what was expected. So I think that's, part of the reason we saw a pretty nice recovery up to this point.
Okay. So ultimately, I think what I'm hearing you say is like what the market was anticipating is what's in essence happened, and the market likes when what they predict happens, right?
Yep, correct.
Okay.
Market's
Okay.
always forward looking, so that's a good thing to remember. So yeah.
Okay. So I think, I'm looking back, I get my weeks mixed up a little bit these days. Old age will do that to you, man. But um, the market seemed a little skittish there a week or two ago. And, when I think you just compare a week or two ago to today, I mean, we're at all-time record highs, and we actually just could keep setting new highs. Like, I think that's shocking a lot of people, right? To be where we're at. Does that shock you at all?
Um, a little bit. I think people were expecting the impact of these tariffs, the ones that have remained in force, to take effect immediately. And as far as I know, I don't think it works exactly like that, right? It takes time for everything to trickle down to the consumer at the end of the day. So getting into earnings a little bit, as I'm sure you know, we've seen a lot of positive earnings. What I mean by that is from this quarter specifically. Now, with earnings always comes guidance from these companies, and what you've seen is the guidance is not looking so good. So the stock might go down anyway, even though this last quarter was positive for them. So again, yeah, I think up until this point, we haven't seen a huge effect from the tariffs yet. So we've been rallying this far.
Yeah, I mean it's been quite a rally. I actually think back to like the beginning of this year, and there were a few like really big companies forecasting like almost a 7,000 point S&P 500, you know, uh, year. And people are like like what an idiot, right? Like why would they even forecast that? And now, we're in the middle of August, and like it actually is quote unquote possible, in theory. So, I think it's interesting, of course, how the market works and the different variables. So you had mentioned like the labor market, and, it just makes me think of, where the stock market started to go down is when it was announced kind of a very massive downward correction of, new jobs created, and that, ultimately got the market a little skittish. I thought that what was interesting is like blonde, yields were actually decreasing in correlation with the stock market, and we don't typically see that. Now, once again, that only lasted a couple days, but any layers you can peel back on that? Because that I've never seen that, frankly.
Yeah, so real quick, I wanna touch on tariffs again real quick because I brought some notes with me today.
Wow.
Now this is a report from Goldman Sachs, which I know there's been some back and forth. I don't know if you've seen with Trump and Goldman Sachs lately about potentially the data, according to Trump, not being legitimate or as qualified as it should be. Nonetheless,
A lot of back and forth.
yeah, from that top institution though, they thus far they reported that 64% of the cost has been absorbed by U.S. companies, 22% absorbed by U.S. consumers, and then the other 14% coming from foreign governments. Um, what's interesting is Goldman Sachs, even more recently, just put out that they're estimating that consumers could bear up to 67% of the cost by October. Um, which is interesting, right? Because that's where that lag could come into play. Maybe we aren't seeing the full effect of these tariffs yet. So the U.S. consumer, obviously that percentage could continue to increase. So I thought that was just interesting, real quick to add there.
So actually, I think what's even more interesting, and just for our listeners, we are recording this on August 13th. So we just had CPI data yesterday. PPI, which is the Fed's preferred, measurement, is going to be released tomorrow. And so you bring up inflation. Are you concerned, or are you mindful, I suppose, would be a better term, of inflation? Because like yesterday, core CPI actually, came in a little bit hot than what we expected. And I thought what was interesting is you start to strip down that data and you look at different sectors, you can see which ones are most impacted by tariffs are up dramatically, you know, per month. And when you start to compare that per month data, like it's higher than what we had seen in the past per year. So I just thought that was an interesting data point, and it just kind of piggybacks to what you said. So my question just becomes, knowing that statistic there, that report, like, boy, are these next couple months critical?
Yeah, I think so. You definitely want to be mindful of it. Like you said, CPI for July, I think came in about 0.2% higher month over month. And unemployment, excuse me, came in 0.1% higher month over month. So, I mean, these aren't massive swings. But again, it's kind of more about the trend, right? If we continue to see that growth, maybe even exponential growth, maybe it's going to, continue to go up higher. Obviously, then, we would say that tariffs are having, potentially a detrimental impact to the economy. Now, on the flip side of that, one other tidbit I want to add is also from Goldman Sachs, or actually, excuse me, CNBC. They reported that tariff revenue thus far, as of July, was about 142 billion in inflows. So the reason I wanted to say that, I guess, is simply just because we are seeing, you know, serious amounts of cash come into the country as obviously Trump has been, saying that would be the case. And then obviously you have some other economists that disagree, but thus far we have seen, quite a hefty amount of inflow.
So what I'm gathering is it's clear from, that part of the policy, it's helping, in essence, it's helping economic growth.
Hmm. Yeah.
Okay, that's interesting. So I mean, you just kind of have these two sides to the equation, and I think regardless of what side you fall on, if I just try and look at things from the from a an equal lens, like I can see from the Fed's position, while yeah, notoriously they're a bit late to the party, if you have a resilient economy so far, and at that point in time the labor market wasn't as weak as what we now know it might be. It's easier to stay put for another 6 weeks, rather than start to decrease interest rates and fuel inflation further, than what it already is, because it is too high currently, regardless of how you look at it. So anyway, that's interesting. I like that type of preparation here. So we've talked a lot about, just the economy and the Fed. If we just look at market performance as a whole, one very interesting part of your, commentary that you send us was that, number one, or two parts, I'm sorry, 8 of 11 of the S&P 500 sectors finished positive. The worst sector last week was healthcare, and healthcare is nearing 3-year lows. Any feedback maybe as to why it's nearing a 3-year low, and is there potential value in the healthcare sector, looking ahead in the short term?
Yeah, so I think the biggest reason would be just the scrutiny that they've come under, from various parts of the administration. I think that's the biggest thing. Tariffs obviously are playing a role as well. So that's going to impact earnings again and maybe forward guidance. Next, I would say there's definitely opportunities there. Things like United Healthcare, personally, here we think that's a company that's not going to go anywhere. I know there's a lot of controversy around it, but it's one of the biggest healthcare providers in the US. A name like that, we think there could potentially be some value. Um, Not so much in the drug development space, the biotech, but again, we try to find opportunities, obviously, wherever we can.
Okay. Yeah, I mean, I think from a pharmaceutical perspective, like the one side is like, I mean, there's billions of dollars, being lobbied from, with these pharmaceutical companies, so it's hard, to bet against them, but they also have a massive target on their back, so it's almost just a tread lightly situation. And I would, I agree with you on United Healthcare and our firm's kind of thought behind it. Massive institution and frankly just a lot of institutional buying
Mhm.
happening over the last couple of weeks. There was like this fear of, is there something going on behind the scenes that we don't know about? And I think if anything, a lot of this institutional buying does suggest otherwise. Um,
One other
so
thing I would add to that also is just kind of tack that on to AI, right? Companies, especially younger companies that are going to be able to leverage technology like that, whether it's to build tools or maybe it is to come up with better medicine, just anything that they can leverage AI with. I think those companies in the healthcare sector are obviously going to be benefit long term.
it's a good point. So speaking of, maybe top sectors, um, looking ahead, right? Maybe if we just look ahead the next, month or two, or the rest of 2025, are there, two or three sectors that consider to be the kind of the top ones to be looking at?
As far as sectors go, I would say it probably sounds redundant, but obviously tech. Um, there's just so much money flowing into the tech space that um, a company would really have to mess up, right, to not grow. They'd really have to do something bad. Um, Also, I would say we're looking at international as well. I know that's not necessarily a sector, but we did slightly increase exposure to some international via ETFs and vehicles like that. Obviously, we mentioned healthcare. There's a couple opportunities, but again, I would say the biggest one is large cap tech, and then zooming out a little bit to more asset allocation. Large cap in general, we like if as the economy continues to slow, right, it's going to be harder for the small caps and even the mid caps to operate and generate positive returns.
Cool. No, I like that. Before we go, one thing I want to touch on too is the bond market. Like what is going on with the bond market? There's two parts to my question. Like number one, like it's so tight. You know what I mean? In terms of like, from 30 years to just a 10-year, right? Just looking at how tight that spread is. Why? And like, is it ever going to change, or is just the way monetary policy is today? Like, is that just it is what it is type thing? And I feel like yields have decreased obviously a little bit, but are hovering currently. Is that just because of our stay put kind of attitude right now? Or is there something else going on from a bond perspective? Like, is there opportunity in bonds?
So I think that I don't think the bond market will ever be the same as it was maybe 30, 40, 50 years ago.
Hmm.
Just like you said, just because the way our monetary policy works and has been operating the past 10, 20 years. um, we're going to continue to print money. We have the strongest consumers. We're going to continue to grow. um, as far as value, I think there is definitely value in the bond market. Obviously, short-term rates have remained, pretty high, a lot higher for longer than most people thought. So I think there's obviously some opportunities there. Once we do start to see a decrease in rates, I think that's where we may see kind of a getting back to normalization in the bond market as far as the yield curve goes.
Okay. No, that's good feedback. It's just something that I've been noticing, and I'm sure, there's a few out there that have some questions. But look, man, I know you got a lot going on. We got, Salmon Man there behind you. So I won't keep you any longer. I just want to say, man, I appreciate you, taking the time, providing a lot of your valuable insight, and, hopefully get to chat again soon. So appreciate you.
Yep, appreciate you. Always good to see you.
This was Digging In Podcast, presented by Rooted Wealth Advisors.
Like that was actually really good. I learned a few things there.